afternoon, everybody, depending on where you are. We're very pleased to be hosting this second webinar in a series on EB-5 success strategies. Today's topic is, I think, timely, focused on preparing for the I-829 bubble. On the call with me today, I'm joined by two of the industry leaders in the space, Mr. Jeff Carr from the Economic and Policy Resources Group. Jeff is a leading economist, business plan writer in the space, has been involved with many of the leading projects, and is a well-known expert. Also, I have joining with me Ron Klasko from Klasko, Rulon, Stock and Seltzer, one of the leading immigration firms. And Ron has a tremendous amount of experience specifically with respect to I-829 processing. So what we'd like to do today is walk through this agenda. I'll explain a little bit about who NES is, talk a little bit about what we mean when we talk about the I-829 bubble, and then turn it over to Jeff and Ron to talk more about the realities of what's going on in the marketplace from their respective perspectives. And then at the end, for the last few minutes or so, I will talk to you specifically about solutions that our company, NES Financial, has developed that we think aid issuers tremendously in preparing for this. So without further ado, our company is really a combination of a technology and a financial services company. We focus specifically on developing technology which we use to offer services to make highly specialized transactions safer, more transparent, and more compliant for all stakeholders involved. EB-5 is such a transaction type that meets those characteristics where typically banks are a little bit nervous about holding EB-5 funds. As with many government programs, there's a tremendous amount of reporting involved. And in fact, there's a lot of compliance types of things coming down the pipe and continuing to expand, as we'll talk about more today. We've had a tremendous amount of success in the marketplace with our solutions. Today, we're active in over 200 EB-5 projects, probably represents close to $10 billion in EB-5 capital for projects of all sizes and a variety of different industries. The I-829 bubble is something that is becoming apparent as something we need to prepare for. When you look at the information that's available on the USCIS website that compares the number of I-526 approvals per year to the number of I-829 submissions per year, what you start to see is that there was an increase in the number of I-526 approvals starting towards the end of 2008. It was sort of a step function at that time in terms of the rate of approvals. And if you add a few months in for establishment of residency and then run out the conditional residency period of 2 years, you see on the other side, in terms of 829 submissions, a significant increase in the number of 829 submissions at that time, starting in 2011 and continuing through now. If you then look at what's happened just in the last year and a half, 2 years, you can see there was another step increase in terms of the number of 526 approvals. And so if you kind of do the same math and draw that out, we should expect a significant increase again in the number of I-829 submissions. So the purpose of this webinar is really to talk about how to best prepare for this upcoming increase in the number of I-29 submissions. So joining me on the call today to review this in terms of what you need to do from a business plan and economic report perspective is Mr. Jeff Carr. So I'll turn it over to you here, Jeff.
Thanks, Reed, and good morning or good afternoon to everybody, depending upon where you are. I'm delighted to be here and delighted to be here with Reed and Ron and the whole presentation team. From the standpoint of who we are, in case somebody doesn't know who we are, we're very much an applied economics firm. We're located in the outskirts of Montreal, Quebec, northern Vermont. We have 11 professional staff, most of whom work on EB-5. Not everybody works on EB-5. And actually, our first assignment in EB-5 was back in 1997 when we were part of a group that helped the State of Vermont Regional Center obtain its approval in that year under then Governor Howard Dean. Since that time, and like everyone else, we went through a period where we didn't do very much with EB-5 until about about 2004. And since then, we've been involved in, over 100 assignments. We've, last count, assisted more than 40 regional centers. We've written, great number of EB-5 project business plans and regional center business and operations plans. We've assisted clients with getting hundreds of I-526 approvals that are attached to our projects. And consistent with the substance of what's going on today in this webinar, we've been involved in a little bit more than 100 I-829 approvals, and there is a decided reduced level of activity that have progressed all the way through the I-829 approval phase relative to the I-526 phase, and Ron's going to talk a little bit about that later, about why that's happening. But, from our perspective and in our experience, our clients simply haven't had their projects going for long enough to have a lot of I-829 submittals, or much less approvals. I served as a member of the Best Practices Committee of IIUSA, which is the National Regional Center Business Association, serving under our esteemed chair, who is the other speaker with regard to immigration issues in this webinar. And I also was a VIP speaker at the Shanghai EB-5 Investor Summits, the inaugural one in 2011 and 2012. And so far, I guess over the last two cycles, I've been able to having to avoid going to China, but not sure how much longer I'm going to be able to do that. I just wanted to start with a couple of basics. I know that there's a lot of experienced people in terms of the EB-5 program on the line here, but I still wanted to emphasize a few points. I mean, the big thing about EB-5, it is a jobs program, and investors gain permanent residency status in this country if they make an investment that creates the required number of jobs. The required number of jobs, the magic number is 10. And it's 10 as they count under EB-5 rules. So 10 per investor is the key number. The different, under the regional center, under the direct program, they have to be 10 jobs for the new commercial enterprise or a wholly owned subsidiary. So they have to be related directly to the business enterprise that the EB-5 investor makes their equity investment into. But under the regional center program, which is where we come in when we're as economists, we have to demonstrate that the 10 jobs, which can be created both at the subject business enterprise and out in the rest of the economy, which is commonly referred to as multiplier effect jobs, which are indirect jobs in EB-5 program speak, economic indirect jobs, and we're going to talk a little bit about definitions in that regard later, as they are estimated through a term that the USCIS uses called reasonable methodologies. And that's where we get into discussions with the USCIS in terms of how the estimates were done for these multiplier effect jobs that can't be supported by payroll records or anything like that because they happen outside of the business that's the subject of the EB-5 project. And so we have to develop estimating techniques, and there are a number of people in EB-5 space that have done this work and know the rules and know how to do this in a way in which we can present a reasonable methodology. The other thing that you also need to know is that in certain cases, at what USCIS defines as troubled business enterprises, which are very specific tests, sometimes projects can get involved with preserving jobs and having those count towards the 10 job per investor requirement. However, it's a special case, and it's not really used as frequently as some of the other approaches to get your 10 jobs per investor. Now, the economic and job impact study really relies on the EB-5 project business plan to estimate the job impacts of the project. it has to be a credible business plan that really supplies all the supporting information and testimonials. It lays out performance data for the project, which basically becomes the auditable track at I-829 for performance on what was represented in the EB-5 project business plan. And this project business plan says that people are going to make investments in things like construction, fit-up, they might remodel something, they may buy equipment purchases, they may provide initial investment capital for working capital purposes to the business. That there are certain investments that are going to be made. There are certain business activities that will be undertaken. For example, if you elect to try to count for in your EB-5 program job benefits, jobs that are created by the operation of the business, you need to include supporting pro formas, and the economist will make an estimate of the job effects of the operations of the business that may have been the subject of the construction as well. And it's interesting because I don't know if other people, and I don't know if Ron's noticed this in his shop, but we have noticed that we get sometimes some pretty hard questioning on the operations side of the project. Particularly we get it at the I-526 level, and it almost seems to us that the service may be drifting towards the notion that operations activity jobs are more risky when we get to the I-829 process, and they're more risky because it may be harder to perform on operating a successful business and making all the hires that you represent in your business plan versus setting forth a construction budget and spending at least the amount that you plan to spend over the timeline that you do for your construction budget. And, you know, like the marketplace has come to understand, if you put forth a project construction budget that says you're going to spend $25 million on constructing something, chances are you're going to spend $25 million and some more, because we all know that change orders and cost inflation and things that are discovered during the construction process typically add more to the construction spending than's represented in your earliest plans. That's why we have things like construction contingencies and those kinds of things in our budget. And this is important because the business plan then takes the investments that are made, and if business operations activity is part of your project, they take all of that and put it on a clearly defined timeline, which deals with the issues I think that Reed was talking about earlier, and Ron will talk about when he gets into his remarks. And, you know, the economist and the business plan writer have to take the project development plan and relate it back to what the expected immigration case adjudication timeline is for the investors that are going to be potentially investing in your EB-5 project. All this is important because when the economist sets forth their opinion of job and economic impact, this economist's opinion is going to be relied on, and people like investors are going to act based on the findings of the economic and job impact report. Oops, I clicked on the wrong thing. Sorry, guys. There we go. Now, when we talk about how many jobs per investor is required under the EB-5 program, 10 jobs per investor sounds fairly benign. I mean, it's pretty straightforward. How complicated can it be? You just got to show that you have created 10 jobs per investor. But the USCIS, like every government agency, has rules. And there are rules for counting jobs that qualify for EB-5 program job benefits. And the first rule is that they must be permanent. The USCIS says pretty clearly that they can't be seasonal, part-time, full-time equivalents. FTEs are just no-nos. If you're going to do an EB-5 project, I tell people, just forget about strike FTE from your vocabulary, because if that shows up anywhere, in my experience, it's an automatic RFE. In a regional center program context, it's important for everybody to understand that the new jobs that are created by your project, we have to show in the economic and job impact study that the new jobs to your project are also new jobs to the economy. And we have to do that especially for the region that comprises the regional center. The USCIS wants to know that your project isn't going to simply rearrange the deck chairs of the good ship economy. They want to know that the jobs are new, and that if your new project comes in to an already crowded marketplace where demand's being sufficiently met, they want to just make sure that your new shiny hotel isn't just taking room nights away from another hotel, for example. And so I think you need to address that. I've never seen a project rejected because of the cannibalization of sales from one business to another, but they will give you a hard time, and you do have to address this issue and demonstrate to them that the jobs are new. The positions also, and when we talk about jobs, 10 jobs in EB-5 context, we're really talking about positions. They must be filled by workers that have legal status to work in the United States. So particularly if you're using direct jobs as one of your inputs into your economic and job impact study, you are going to create an obligation and a burden to prove that not only the payroll records are accurate, but also the payroll records reflect workers that have legal status to work in the United States. We also have the 24-month rule. The 24-month rule for construction projects. If your project is under 24 months in terms of duration, and this goes back to the Neufeld memos back in 2009, only economic indirect jobs are allowed. You can't count the direct jobs associated with construction, which if you look at a construction project, most of the direct jobs are people that actually show up and work on the site. They don't include the indirect jobs like people that work at the cement plant that supplied the concrete or the steel plant that, from the supplier that supplied the steel. If you're 24 months plus, you can use both economically direct and economically indirect jobs. And if you were to break out between the two, a good general rule of thumb is that economic direct jobs, depending upon the type of construction, can comprise anywhere from about 45 to 55% of the construction job total. So it's important to figure out whether or not you have a construction timeline that, as a matter of customary time length in your area that you're constructing for the type of project you're constructing, takes 24 months or longer. At the I-829 phase, and I know this is a favorite of Ron Klasko, and it's also a favorite of mine, there seems to be this guideline, and they will give you a hard time at I-526, that you must demonstrate that the jobs have to be created within 2.5 years of the I-526 approval. I mean, that totally ignores issues like retrogression and the time period that they're taking to approve I-526s these days. But even so, if you don't somehow fall into that time dimension, they are going to ask some questions, and if you have a project plan that doesn't fall within that time dimension, you're probably going to get an RFE. And then, of course, I-829 adjudications are based on actual performance, or an expected performance over what they call a reasonable period looking forward, which if you look at the May 2013 guidance memorandum, is reflexively about a year, unless you can demonstrate that there was some special factor or force majeure, as they put it in the adjudications guideline memo, to allow you to go longer than a year out into the future. Now, as I said earlier, EB-5 job counts must use reasonable methodologies, and a reasonable methodology is that they tend to rely on the use of input-output tools. And for those, we have common tools like InPlan, REMI, Redine, and if you go to EB-5 Program Head Nicholas Carlucci's statement back in early May at the IUSA meeting in Washington, D.C., he mentions InPlan, REMI, and Redine by name. He did not, by the way, mention RIMS 2 in that sentence, which I thought was very interesting, although I know that there are still projects that to a lesser extent now are using RIMS 2, but as we're all concerned about, the fact that the U.S. Department of Commerce, Bureau of Economic Analysis, isn't maintaining technical support on RIMS 2 multipliers nowadays, you have to wonder, multipliers that are, last based on 2010 data, as we get into late 2014, 15, and into 16, whether or not there's going to be at some point in time that the USCIS is going to say that data is too old. But all input-output tools that are used, even the custom ones like they have in the state of Washington, all use the same underlying federal input-output data. And the interesting thing about EB-5 Program Head Carlucci's comments in Washington, D.C., and we've also seen this in conversations that we've had with adjudicators as part of our projects and some of these clarification calls, and we've also seen it in some of the RFEs that were late last year, early this year vintage. It is clear now that economic job reports must separate economically direct and economically indirect jobs for each NAICS category or sector involved in your input-output work and involved in your project. And I put down there for you the actual language, which says that the economist preparing the analysis for the regional center should provide the number of direct and indirect jobs attributable to each of the model's inputs. So you really need to keep job category definitions clear, and there actually are two, as Mr. Carlucci said, two types of direct and indirect jobs. One is as it relates to the immigration definition of direct and indirect jobs, and the other as it relates to economic. And the difference between the two are very important to keep separately, and it's very important to understanding what's being communicated to you. In the immigration world, and Ron can correct me if he thinks I'm wrong on this, direct jobs that are immigration direct jobs are W-2 jobs of the new commercial enterprise. The new commercial enterprise being that enterprise that the immigrant investor makes their equity investment. Immigration indirect jobs are all other jobs that are associated with the EB-5 project that are not W-2 jobs of the new commercial enterprise or a wholly owned subsidiary. Economic job definitions are different than that. Economically direct jobs are jobs that are really what economists refer to as first-order effects of either the EB-5 capital investment or the business activities, such as construction jobs that are on site, expenses related to the direct jobs of an EB-5 project business operation. Economically indirect jobs, which also includes the induced jobs, they're a subcategory of indirect jobs from an economic perspective, are jobs that are second-order effects. Jobs of construction suppliers, contractors, suppliers and vendors for the operations of, say, like a hotel. Induced jobs are also a subcategory. They're basically the wage and income effect jobs. So for example, if you have a construction job that's on site and that worker goes and spends money on food, clothing, going to movies, cars, entertainment, those other types of entertainment, those are commonly referred to as induced jobs. So you can see that the immigration direct category is a very small subset of jobs. And the immigration indirect can include both economically direct and indirect jobs. Very important to keep that in mind. In terms of suggested best practices, I think it's important for you to set the stage carefully and correctly from the outset in order to make your I-829 experience less eventful, as uneventful as it has to be. And what I say to people is, remember, the decisions that you're making now at the earliest stages of your EB-5 project design are decisions that you are going to have to live with, perhaps 5 to 7 years out or longer. And you really need to think around the bend to make sure that your project is positioned properly to make it easy for your investors to have their jobs to be quote-unquote proven at the time they need to be proven. There is more to an EB-5 project for you as a project sponsor than just getting to the point where you get access to the money. That's what we normally say to people. We also encourage people to be very thorough and complete. This is very highly detailed and exacting work. Do not cut corners. If you do your homework up front, you'll save yourself a lot of time lost and agony later in EB-5 I-829 reviews if you're thorough and complete, do your homework in a very forthright and upfront, highly detailed way at the beginning of your project. And then the other thing I think that's important is we say to people, if you think you're going to spend $25 million to build your hotel, and you think you may end up spending more, make sure that you pick a conservative number. What you don't, if you say you're going to spend $25 million and your construction activity jobs are generated off that $25 million number, it's generally okay. It's okay if you spend $25.5 million or $26 million. It may not be okay if you only spend $20 million when you say you're going to spend $25 million, because a miss on the low side means that you're going to create fewer jobs. And while most projects have surplus job cushions as demanded by the marketplace, sometimes a 20% or 30% job cushion can disappear quickly if you find that you spend less on your project than you originally planned. Now, I know for most developers, it's kind of shocking to think that actually spending less money would be a bad thing. But in the EB-5 world, where your job creation estimates are based on spending a number that's higher than what you actually spend, that means you created fewer numbers of jobs than you planned, and that can create problems for your investors at the I-829 level. If your EB-5 project economic and job impact is found to be invalid, then you may have to redo it. So I guess with that, aside from keeping it simple and as straightforward as you can and avoiding the many controversial issues, my time is up.
Thanks, Jeff. Let's turn it over to Ron Klasko now, who's going to talk more about the realities of what's going on in the real world related to 829 submissions, RFEs, et cetera. So, Ron, over to you.
Thank you very much, and hello, everybody. It's my pleasure to talk to you about a very, very important, probably the next major important topic in EB-5, and thank you so much to my friends at NES for giving me this opportunity. By way of introduction, I have just completed my 4th term as chairman of the EB-5 committee of the American Immigration Lawyers Association. As Jeff mentioned, I had the honor of chairing the Best Practices Committee of IIUSA, and we came up with quite an extensive best practices document. But I think the most important thing for purposes of my addressing you today is that I and our 20-person EB-5 team here at our law firm have represented quite a large number of regional centers and project developers, including regional centers and project developers that are old enough to have gotten to the 829 process. So we actually working now with the NES team and their great software project have developed a compliance team that works with our regional centers and project developers in putting together I-829 packages, and hopefully not starting at the very last minute at the end of 2 years, but working on an ongoing basis. So let's start with, Reed talked to you a little bit about the spike in 829s. Let me put some context on this. Unless you are a regional center that has been in business with active projects since I'd say about 2008 or 2009, you probably have not gotten to the I-829 step. Between the time it takes with an active project to find investors, to have investors invest, to have the I-526s approved, to have the consular immigrant visa issued, then they have 6 months to enter the U.S., then 2 years to file the condition removal, and maybe another year to get it approved. There really are only the oldest of regional centers have actually gotten to the point of filing 829s and certainly getting 829 approvals. And we've had the privilege of working with a number of them, and we've really been able to put together successful 829 packages for a large number of projects. Now, this is all going to be changing because, obviously in the last several years, many of you on the call, including many of our clients, have put together successful projects. And it is likely that in the next months or years, you're going to, for the first time, reach the I-829 process. Now, there's some concerns here. Certainly, it's a concern that I and my team have, that with a lot of the clients that we worked with that have been around a long time, they have substantial in-house staffs gathering together all of the necessary documents. And we're trying to make sure that our newer clients are doing what they need to do, because this can be a document-intensive process, as we're going to talk about, to make sure that they're not waiting till the last minute to put this together. And there are great risks to investors if the regional centers and the projects are not doing everything we're going to be talking about and that Jeff talked to you about. And there's great risks to the entire EB-5 program if somehow there are a number of projects, or really any projects, that haven't done their homework and haven't done everything necessary to be able to file 829s for their investors. So Jeff covered a lot of the basics, but basically we know that we have to file the 829 between 21 and 24 months of their obtaining conditional resident status, and that can often be up to a year or so, or sometimes longer after the 526 approval before the 2-year period starts. We need to prove that the investment has been completed. If you read the regulations, it says that you could still be actively in the process of investing. I don't suggest living a life filled with that level of risk. So completed the investment, sustained the investment. So we'll talk about this a little bit, but it's not just that you completed the investment, but you haven't taken any of the investment out by the time you get to the 829. And all of the necessary jobs have been created or will be created within a reasonable time, and that's very often a key issue in the work that we do on the 829s. So I'll divide my remarks between direct EB-5s and regional center EB-5s, and we have been actively involved in the 829 process for both. The main thing I will tell you on direct EB-5s, and it really also applies to regional centers, but be involved with your client from day one. So your work is not completed by any means when the client becomes a conditional resident. Your work is just starting on the compliance stage in the 829 work to be in a position to file a couple years later. Key issues on direct EB-5s are proving that the employees are qualifying employees. That means that they must be U.S. citizens or permanent residents. They must be W-2s, not 1099s. And this is an RFE issue and can be a denial issue if they're 1099s. They must be full-time employees. We're going to talk about how you document that. And I'm not going to go into much detail today, but be aware that there are issues regarding what you can and can't ask employees and when you can and can't ask employees, because you can't discriminate on the basis of national origin or citizenship. So what documents do we need? We want to gather the W-2s for all of the employees, IRS quarterly returns, 941s. We like to present I-9s, although technically the I-9s don't prove anything. Very often the I-9s don't have proof of citizenship or permanent residence, certainly not proof of full-time employment, but we like to present them. To prove full-time employment, we need internal records. There's no government forms that are going to prove this, so we want pay stubs, we want time records. A lot of times we're going to want, if we have a 24-hour operation, a hotel or a 24-hour restaurant or nursing home, we're going to want an organizational chart showing employees per shift. And we need to prove U.S. citizenship or permanent residence for each of the employees. Some of the issues we deal with in direct EB-5s that can be RFE issues, and we do everything we can when we put the packages together to avoid RFEs. One is if it appears that a number of the employees were hired shortly before the 829 filing date. For the last 2 years, the company had 7 employees, and then all of a sudden 3 weeks ago there are 10. There's obviously a credibility issue there that we want to deal with up front. Maintaining employees during the pendency of the 829. The Immigration Service takes the position that it's not sufficient that you have the employees on the day the 829 is filed, but that they need to be there when the 829 is approved in case there's an RFE asking for that. There is no requirement that the employees have been employed during the entire 2-year period. So it can be, it's perfectly proper to start with 2 employees and 3 months later you have a third, et cetera, and over time, by the time you get to 829, you have 10 employees. That's okay, but you need to show that they're permanent. You didn't just hire the employees to be able to file the 829. There's a difference that can be critical between positions and employees. In my opinion, I've dealt with this on 829 filings, the issue is the number of positions. So let me give you an example. My company had 10 employees, but we had to fire one for cause and one quit. And all of a sudden, by the time we're at the 829 stage, we only have 8 people. In my opinion, as long as there are 10 positions and I can show that I'm actively in the process of recruiting to fill the 2 open slots, I have met my burden of proof. The Immigration Service has not yet made that completely clear. Another issue we deal with on direct EB-5s, on the sustaining the investment issue, is if money has gone back from the company to the investor, there can be issues. So if a company has made a significant profit and has returned some of that profit to the investor, well, that's fine. That's a return on capital. If the company has made no profit and the investor has taken money out, that's a huge problem. Because if there's no profit, that's a return of capital, which means some of his investment has not been sustained. When the investor's taken a salary, we have issues we have to deal with. So let's move on and talk about regional center EB-5s. Now, usually in most regional centers, we're not dealing with any direct employees because most regional centers are loan models where the new commercial enterprise is the lending company, and the lending company has no employees, and therefore there are no direct employees. All the employees are indirect and induced. And the key then is documenting the inputs to the economic report. So you're not starting from scratch. You are taking the 526 economic report, and in the best case scenario, whatever the inputs were, the revenue inputs, the expenditure inputs, the occupancy inputs, et cetera, whatever the inputs were, you are able to document that they actually happened. And if they did, you have a smooth 829 process. If they don't, you have a much more difficult 829 process. Many of the successful EB-5 projects rely mostly and in many cases solely on construction jobs. And so you have to document in detail, sometimes invoice by invoice, all of the construction expenditures. And if the amount of the construction expenditures is at least as much as the economic report used in its projection, then you don't have to prove out again the jobs. Construction timeline is critical. As Jeff mentioned, there's a big difference between 2+ year construction timelines and construction processes that are less than 2 years. If you projected a 2+ year construction period, which allowed you at the 526 stage to use direct construction jobs, and if you do what you would like to do in the real world but not in the EB-5 world, is you completed the project ahead of schedule, and therefore you didn't take 2 years in the construction period, you can have big problems because you relied on direct construction jobs that may no longer be available to you. So you have to document the construction timeline. Some of our 829 projects, we've had issues of, who knows, maybe there were strikes or weather issues or whatever, and we had some where we projected the construction would take less than 2 years, but in fact, because of delays, there might have been various months where there was no construction going on for various force majeure or other reasons. It ended up taking more than 2 years, and we were able to use that to balance out the fact that our construction expenditures or our revenues were less than we anticipated. Other things that are used on operations jobs in CAR's economic report and other economic reports are going to be revenues, occupancy, square footage, direct employees, etc. And all of these, whatever the inputs are, need to be documented. So what are we talking about in documentation? We're talking about extensive documentation, and I can tell you as we go through this, and I was not paid to give a plug here, but the NES software that our firm has previewed, and it's really terrific, can be a huge and critical software package to do everything I'm going to be talking about in terms of documentation. So what do we need to do? We need to document the construction expenditures, a draw package, invoices, bank accounts, canceled checks, operations jobs, tax returns, financial statements, cash flow. It's absolutely critical that all of this be documented in real time. The one thing you don't want to have happen, and we've had it, is have the client come to you at the end of the 829 period and said, our first 829 is due in a month, and we really haven't been keeping very good records. What do we do now? That is panic time for absolutely everybody, and I know there are members of my EB-5 team on the call now chuckling as I say that. The best thing is for you, as if you are an attorney, to be working with your regional center client on an ongoing basis. If they're using the NES software, they have a step ahead, and we can work with them to make sure that this is not a panic kind of a process. What if there are delays in job creation? Well, then you need to prove, if you don't have all of the necessary jobs by the time of the 829 filing, you have to prove the jobs will be created within a reasonable time. And for the first time in the May 30, 2013 policy memo, USCIS, for better or for worse, has defined reasonable time as a specific time period of 1 more year. So as a practical matter, you now have 3 years from 829 filing to prove the job creation, although you sleep better if you have all of the jobs at the time of the 829 filing. If you're relying on reasonable time, then you're going to be dealing with proving why it is that the project will in fact be completed and the jobs created in 1 year. Last thing I'll mention is the issue of tracing money from the investor to the NCE to the project. All of those steps need to be documented. Either you're going to do it or working with NES, they're going to help you do it because their program deals with this. But you need to show the money going step by step by step. And one issue you have to be concerned about is if the money is paid back to the NCE before the investor's I-829 is approved. We know if it goes back to the investor, there's a huge problem. If it goes back to the NCE but not to the investor, that's a possible problem because the Immigration Service has not yet sorted out what its policy is. So as I mentioned, prepare in advance, document thoroughly. It's a good idea to keep your investor updated, and all the things we've just talked about will help you to avoid RFEs. Reed?
Thank you, Ron, and appreciate the overview by both yourself and Jeff. So what I wanted to do is transition a little bit into the discussion of potential solutions for this challenge. In summary, and I'm simplifying here, there's really sort of 4 things I'm going to focus on in terms of ensuring a successful 829. And the 4 things that are required are evidence that the new commercial enterprise was established. The investor must make a full investment into a new commercial enterprise, so meaning the full, in a TEA space, full $500,000 investment. The fact that the full investment was sustained at risk, to Ron's last point about when the settlement comes back, is critical. Being able to show that the investment was sustained at risk is critical. And that the job creation requirements were met for each investor. This is what Jeff talked about. So as a refresher here, when you look at this, this is really the administration life cycle for the EB-5 funds. Investors are making an investment. The focus is really on an immigration result. So they're really in this thing for somewhere between 3 to 5 years. And the money flows through this typical cycle, where it flows into the subscription escrow account, which is commonly used. And then from there, once those conditions are met, the money moves into the new commercial enterprise where it gets deployed into the job-creating entity. Sometimes there's an escrow account used there. Commonly, there's at least some type of draw or tranche controls implemented. And then once the life cycle of the project is complete, the money gets returned to the investor. But along the way, depending on the model, and in the loan model as an example, there might be proceeds that are at least accruing for the investor in a settlement account. Traditionally, I think the approach that's been taken by many issuers is sort of summarized up there on the left, where there's a variety of different tools being used to support the workflow within a regional center to kind of track the flow of the money, to track and maintain all the documents, to put all the pieces together. And what our company's done is tried to bring a comprehensive solution together that makes this much more efficient and much easier. We actually have a suite of solutions that are really oriented on having a successful I-829 result. On the last conference call, we talked in some depth about our escrow solutions and our suite of solutions there. Today, we're going to talk more about the fund administration solution suite that we have. And then in a future call, we'll talk more about tracking the immigration workflow. So in terms of the 829 success, it's critical that we track not only the flow of the funds, but all the associated documents along with it. And we set that up at the beginning as ideal. It can be implemented later, but at the beginning is an ideal time to do it, obviously. And along the way, we keep a comprehensive audit trail, the goal being to minimize the number of 829 RFEs and maximize the potential success for the investor. So what I'd like to do today is walk you through a few of the sort of a high-level series of screenshots that summarize how this solution typically works. For a more comprehensive demonstration, we can set something up individually for our clients. Just reach out and contact us via the information provided at the end of this call, and we'd be happy to do that in more depth. What we're looking at here is really the view into the solution from a regional center perspective. And in this example, the regional center is running 4 concurrent projects, and at a glance, the regional center can see the status of funds in each of those different projects. The user experience is such that if you click on one of the items, you drill down. So what you see here is we're drilling in on this bridge replacement project, and you could see that there's different accounts associated with the different phases that I outlined in that flow chart a couple of slides back. So we have different accounts for each of the project phases, but we still get a view of the overall fund status. So the investment money, the $500,000, is held in a separate account from a tracking perspective than are the administration fees. The reason for that, of course, is that the administration fees are used for different purposes. The investment account, the investment or subscription monies are used for job creating purposes, and there's a lot of importance about how that is tracked. From there, the money flows through the different cycles. It goes into the new commercial enterprise, what we're calling here an LE operating account. This is a lending entity type model, which is the most common model. Then it would go into construction. If there was an escrow account, it'd be used there. Otherwise, we just go straight into the developer and then ultimately back in terms of some types of settlement account. When you drill into the actual subscription account, what we do is we start tracking by each individual investor what's going on. So you see here a list of all of the individual investors which have sub-accounts on our platform, but that's contained to one master bank account. So there's one account at the bank, individual sub-accounts on our system for each investor, and we can store project-level documents at this point in the system. So the cool thing, I think, is you can see a combination not just of the status of the funds, but also of the individual documents. So any document can be attached here that's relevant to the project, and you see some listed there. One that's particularly important is the certificate of incumbency, because as you'll recall, it's essential to establish that the new commercial enterprise was in fact created. And so here's evidence early on in the process that there's a real new commercial enterprise in place. Now, going back to the individual investor, same sort of experience applies. We can drill in on any individual investor. We'll drill down on this investor here because we can see that the $500,000 has left the investment or subscription escrow account and moved further down the process. And so here you can see that the $500,000 which came into escrow on June the 1st, left escrow and went into the lending entity or the new commercial enterprise on November the 1st. We can also track all related accounts for that same investor in one view. So we could see what's happening with their administration fees. We can see what's happening with their settlement money. Again, all documents associated with this investor can be attached at the investor level. So you could see all kinds of different information associated here. We generate monthly statements for the investor, important to establish the fact that funds remained at risk. When the money comes into escrow, we'll generate a confirmation letter, and that's maintained in the same place. So here we have evidence that the full $500,000 came into escrow. And then drilling down further, we see when the money left escrow, we can see exactly where it went. So it left on November the 1st, and it went into the operating account for the new commercial enterprise here. And we, of course, track the evidence to support that that full $500,000 investment was in fact made. So you can see here's actually the wire receipt information from the bank confirming that that money moved as it was supposed to into the new commercial enterprise. So just continuing to follow that along now, what you see is on the very next day here, the money left the new commercial enterprise, went into the project itself. When it went into the project, we can track it down to a per investor level to see exactly how that money was used. So this shows the art of the possible, and probably more detail than is typically done, but we could in fact track an individual investor's funds into each individual development tranche, and then following along that line, we can in fact even attach an invoice or a receipt showing how that money was actually spent. So it was spent in accordance with what's in the business plan, which generates the jobs. So another one of the important requirements for I-829 is encapsulated in the solution. And then finally, when we look at the sort of the end result here, we're now in the settlement account. What we can see is that there's all the statements supporting that the investor's funds were retained at risk, which is another essential component of the support for a valid I-829. And then we provide some, I think, very important reports to simplify the filing. So in this report example here, what we're seeing is a complete audit trail of how the funds moved. They came into the subscription escrow on June 1st, left on November 1st, into the new commercial enterprise, into construction, split across the phases, ultimately comes back to the investor after the 829 approval. So as I say, that was a quick overview of the solution. We can show a more detailed demonstration in real time for anybody who's interested. The point here is that preparing for this 829 bubble should start early because there's a lot of documentation required, and this is the most important thing for the investors. So some of the key things we'd like you to take away are, when you're considering setting something up, use an experienced EB-5 team. This is obviously a complicated process and requires some sophisticated support. Set up your operations to be 829 friendly from the very beginning. And as Jeff Carr pointed out, there's some things you can do in the business plan to facilitate that and prepare for that even before the project's gone to market. Be prepared to track expenditures and prove job creation. So it's not just about following the money, it's also about correlating that with documents. And then finally, keeping investors informed by providing update statements and reports is not only the right thing to do in terms of servicing investors, but those statements and reports become extremely important pieces of evidence for the final 829 submission. So with that, let me turn it back over to Katie, and we'll transition to questions. I think we have a number of questions that folks have kindly submitted. So Katie?
Thanks, Reed. Like Reed said, we're going to go ahead and switch over to the Q&A session now. Just as a reminder, if you still have questions and haven't submitted them yet, you can do so by entering it into the chat box on the left-hand side of your screen. And I had received a few questions while the presentations were going on asking about the PowerPoint presentation and if we are going to make the slides available. Those will be sent out in an email tomorrow morning to you guys, so don't worry about that. We're also recording this webinar, so we'll send the whole recording out to you as well. So Reed, go ahead and get started with the questions.
Okay, there's a series of questions related to the length of time for the conditional residency period, when it starts, when it ends, and so on. In my diagram at the beginning of the seminar, I took some liberties by adding in what I figured was a reasonable period of time for folks to actually establish residency. But perhaps maybe a question for Ron Klasko, if you could please review the specific rules related to the conditional residency period, when an 829 has to be filed, when the counting starts, et cetera.
Sure. So what you have is the first step is you're going to get the 526 approved. Then maybe 6 months later or so, if the investor is in China, he's going to go for his conditional immigrant visa interview at the consulate in Guangzhou. Then after that, the investor has 6 months to actually enter the U.S. So it may be that the start of the 2-year period will be delayed for up to 6 months after he's approved for his conditional green card at the U.S. consulate. So one of the things that you as a regional center or a project developer must do, and again we work with our clients to make sure they do this, is to work with the investor's attorney to track the actual entrance date into the U.S. of each investor, because each investor has a different conditional residency period. The investor who entered on Tuesday has 21 to 24 months from Tuesday to file his conditional residence removal application. The investor who enters next week has a week later to file his. So this is actually a sequential process where the job creation may not be completed by the time the first investor comes in, but you only need 10 jobs when the first investor comes in. But by the time the last investor comes in, you're going to need, you have all the jobs. So you're basically allocating jobs on a sequential basis, investor by investor. So then when they enter the country, the 829 can be filed anywhere between 21 and 24 months. In our experience, our clients get a lot of pressure from the investors and the investor's attorney to file the condition removal closer to 21 months rather than 24 months. So it becomes incumbent upon you, to working with us or your attorney, to be prepared in advance, because you'll have a lot happier investors if you file for each of them around 21 months rather than waiting until the 24-month period to file the conditional residence. The conditional residence period is considered to continue even after the 829 is filed. And it may be 9 months or a year from the filing of the 829 until the conditional residence is approved, and all of the requirements we've talked about, including sustaining the investment, continues on until the conditional residence is approved.
Thanks, Ron. I think there's a question here for Jeff. Specifically to clarify the difference between how immigration views indirect and induced jobs versus how economists view them.
That's a good question, Reed, and far be it for me to try to speculate on how the Immigration Service views anything these days, but I can speculate. The economist looks at induced jobs as a subset of indirect jobs. They're just income effect jobs that come about as a result of the jobs that are created as a result of a change in final demand from a project. And so they're really a subset of indirect jobs. Immigration, in a lot of their communications, talks about them as if they're separate categories of jobs. And I'm not quite sure why, but they also call the economic and job impact studies econometric studies. And econometrics really has little to do with it. It's really input-output analysis, which is regional economic science. So that's why, in my presentation, what I wanted to do was make sure that everybody understood that there are two definitions of indirect and direct jobs. One is an immigration definition, which is used for the purposes of conforming to the EB-5 program regulations, and the other is the definition of direct and indirect jobs in economic theory. And the other thing that made Mr. Carlucci's statement about to the IIUSA meeting in Washington, D.C. earlier this year, he says quite specifically in his statement that the Immigration Service does understand that there's a difference between the immigration definition of direct and indirect jobs and the economic theoretical definition of direct and indirect jobs, and we have to make sure that we use those terms correctly so that we don't have confusion.
Thanks, Jeff. We're at the top of the hour, so I'll just take a couple more quick questions here. There's a series of questions for NES, in fact, related to whether, when a solution like this can be implemented, and related to whether it has to be exclusively for regional center projects. So with the second part of that question first, the NES solution can be implemented independent of whether it's a regional center project or a direct project. The only difference really would be in terms of the types of documentation that you may collect or may be sort of more prominent. In a direct environment, obviously, direct jobs are the thing, and so things like payroll records and so on might be the type of document that's much more important than a construction receipt and invoice. But from a system perspective, it's identical. And then the other question is, the way NES has implemented this is it can be implemented on top of any bank infrastructure, any escrow infrastructure, and so on. So, and it, of course, any time. So this can be overlaid, if you will, on projects where there is no escrow, where there's an escrow at a non-NES partner bank, and so on. So please contact us for more information. So two more questions, one for Ron and one for Jeff. One for Ron. First of all, there's a question about retrogression and how this may impact these timelines.
So with retrogression, the main thing it's going to mean for the regional center and the project developer is you're going to have a lot more time to actually create the jobs. From the investor's point of view, it's going to be a lot more time during which he must sustain his investment. So for those of you who aren't familiar, if quota retrogression sets in, it should not affect the ability of the 526 to be approved. The 526 can be approved irrespective of a quota backlog. However, once the 526 is approved, if there's a 2-year quota backlog, it's going to be a long time before the investor can become a conditional resident and start the 2-year period. Again, if it's a 2-year delay, instead of the normal time frame that the project has to create the jobs, there's now 2 more years that the project has to create the jobs. The quota retrogression makes the 2.5-year rule, where immigration says for the 526 that you have to prove that the jobs will be created within 2.5 years of 526 petition approval. With quota retrogression, that will make no sense whatsoever, because what it will mean is that investors will have to prove that the money has been spent, all of the jobs have been created long before they even become conditional residents. That will, I do believe, require a rethinking of that rule. So those are some of the ways in which quota retrogression will impact this process.
Thanks, Ron. Last question for Jeff. There's a question about the issue regarding the RIMS 2 model, and if you could elaborate briefly on that.
Well, one of the tools that has historically been used in the EB-5 program has been the RIMS 2 multiplier sets, which is a program that had been around for decades at the USCIS since input-output analysis came into the modern age into the 1960s. And there's a certain amount of appeal to that model, not from the standpoint that it necessarily provides more accurate results or is appropriate with the level of complexity of your project, but because you could sit down with a marketing agent and you could say, this number times this number equals this number, and that gives you either an economic impact or a job impact based on using the multipliers correctly. Now, we don't know why. Some people have attributed it to the sequestration that happened last year. But in September of 2013, the U.S. Department of Commerce, Bureau of Economic Analysis, said that they were going to no longer support the RIMS 2 multiplier program. And, for a long time they've been cutting back on the program. I mean, you can't get RIMS 2 multipliers that apply to a broader area than a state, like for the U.S., post 2007. And what's happened is that the USCIS, still is kind of very multiplier-centric, RIMS2 multiplier-centric in terms of their thinking about number times another number equals a job impact or an economic impact. But since the Bureau of Economic Analysis has said they're no longer going to support the program, that means they're not going to update them, which means that most of the data now that's used in RIMS2 multipliers, even though there's more recent data available, is grounded in 2010 data, which is now roughly 4 years old. Because other input-output tools like REMI and Readine are using 2012 data sets, there is the potential, and Implan is using 2012 data sets too, there is the potential that somewhere along the line, some reviewers talking to other reviewers in coffee or whatever they do, inside the service center, are going to say the data that's used in RIMS2 multipliers, that's 2010, is simply too old to be considered accurate. And in that case, at some point in time, people who use RIMS2 multipliers in their analysis, maybe next year, later this year, maybe on a case that's already filed, somebody could come back to you and say that you can't use RIMS2 multipliers anymore because the data is outdated and too old. And the fact of the matter is that when you make this kind of a decision with your immigration counsel, whenever you decide to file an application in the way that you do it, you're talking about managing your risk profile of your application. And as we get farther and farther away from 2010, using a RIMS2 multiplier set as your input-output tool to devise your job impact using a reasonable methodology may at some point in time in the future be determined to be unreasonable because it is old and outdated. And that is the concern, and that is the issue that I think all of you should talk about if you decide to use RIMS2 multipliers, or if you listen to the agents over in China, which sometimes insist that you use RIMS2 multipliers because they understand it better than the other tools, even though the other tools are just as valid and probably even more accurate than RIMS2 multipliers, that you have to consider and factor into your conclusion as you file your application.
Thank you, Jeff. There's still a number of questions remaining, but in the interest of time, I'll transition over to Katie, who will explain how we're going to answer those questions. But before I do, I would like to thank everybody for their attendance today. We had a very large response to this webinar, several hundred people, in fact, and so we're very excited about that and appreciate all the support from the industry with respect to what we're all trying to do here. I'd like to also thank my co-presenters, Jeff Carr and Ron Klasko, for their help and support in putting this webinar together. And we look forward to continuing this series in the coming future, so stay tuned. We'll have additional information as to the next webinar in the near future. So thank you again. Katie?
So for those of you that had submitted questions that we didn't quite get to today, we'll be sending you out an email later this afternoon with responses to those questions on an individual basis. We just didn't want to think we forgot about you guys. But thanks again for everyone that listened in. That concludes our webinar for today.